Welcome to the deep dive. Okay, let's get straight to it. Crude oil prices, they're definitely on the move, doing a bit of a dance lately.
Yeah, volatile is the word.
Absolutely. So as of April 17th, 2025, WTI, that's West Texas Intermediate, it's sitting at $62.80 a barrel.
Hmm.
And Brent crude, the international benchmark, is $66.40.
Okay.
Now, rewind just a week, April 11th, WTI was actually a bit lower, $60.07. Brent at $63.43.
Right. So a slight uptick there in the last week.
Exactly. But then go back further, mid-March, energy news had them higher still. Brent was over $70, $70.58. WTI at $67.29.
So yeah, definitely seeing that back and forth you mentioned.
Mhm.
A bit choppy.
It is. And understanding what's behind this constant, push and pull,
Mm.
that's the interesting part.
It really is. And for this deep dive, we've really tried to pull together a lot of different sources, get the full picture.
Right.
We're looking at Discovery Alert's latest snapshots from the 11th and 17th, and there's broader analysis from Energy News, some historical context from Investopedia, geopolitical angles from Atlantis Press, even some fascinating research on market sentiment from Doris at DCU.
Sentiment. Okay. Interesting.
Yeah, plus perspectives from IG International, State Street Global Advisors. It's quite a mix.
Sounds comprehensive. So the mission here for everyone listening is to walk away with a clearer sense of why oil prices are doing what they're doing.
Yeah, cut through the noise a bit.
Exactly.
Yeah.
Give you the key takeaways, maybe a surprising fact or two, but, without it feeling like a lecture.
Definitely not a lecture.
So let's start with the fundamentals. Supply and demand. It feels like that's always where you begin, right?
It usually is, yeah. So let's unpack that. On the supply side, a key thing recently is OPEC plus ZE.
The usual suspects.
Right. Well, they decided to trim output again, another 110,000 barrels per day back in March, trying to prop up prices, as they do.
But it's never that simple, is it? Because at the same time,
No, exactly. Because here in the U.S., shale producers are feeling some pressure to maybe ease off the drilling a bit with prices softening.
right. But then you hear about companies like Chevron getting more efficient. This triple frac technology.
Yes, in the Permian.
Yeah, they're using it in a lot of their wells. So
Yeah.
maybe fewer new wells, but they could potentially keep production up, like getting more out of less.
That's a good way to put it. It's about efficiency gains. Now, flip to the demand side. The EIA.
The U.S. Energy Information Administration.
Right. They're actually projecting slower growth. They're looking at economic deceleration in places like China and the EU. Big consumers.
And didn't U.S. inventories jump recently?
They did. Big jump. 6.2 million barrels reported around April 11th. More oil sitting in tanks. That usually means, well, downward pressure on price.
And the IMF, the International Monetary Fund, they put some numbers on that global slowdown risk, didn't they?
Yeah, they warned that even just a 1% dip in global GDP, that could slash oil demand by 500,000 barrels a day.
Wow, 500,000 barrels. That's significant.
It is, but global demand isn't monolithic. It's not one single thing.
Good point.
For instance, Southeast Asia, still seeing pretty decent growth, around 3.5% annually. That's according to the same Discovery Alert report.
Okay, so pockets of strength. But even there, things like subsidy reforms could affect consumption, right?
Absolutely. It adds another layer of uncertainty.
Now, China, that seems huge. Imports hit a 20-month high, 11.2 million barrels a day.
Yeah, that was in the April 16th discovery alert. And what's really interesting there,
The source.
exactly, a lot of it is coming from Iran and Russia at
Well,
discounted prices.
so the big question is, are they actually using all that oil because the economy's humming, or are they just taking advantage of the discounts to fill up storage?
Precisely, because those two scenarios point to very different things about future demand and, well, prices.
Right. And it gets even more confusing when OPEC itself lowers its own 2025 demand forecast by 1.1 million barrels a day.
Hmm. Their main worry, those U.S.-China trade tensions we keep hearing about.
So you've got OPEC worried about demand, China buying discounted oil. It's a mixed picture.
Yeah. Very mixed. But don't count out U.S. supply. The Energy Secretary is actually predicting quite a rebound for shale.
A comeback for the ages, I think was the quote.
That was it. Projecting a 900,000 barrel per day increase by 2026. Pretty bullish.
So how does that square with the OPEC plus cuts? It feels like they're pulling in opposite directions.
Well, that's the dynamic, isn't it? And the key difference is often the break-even cost.
Right. Shale producers can make money at lower prices.
Generally, yes. Maybe $45 to $55 a barrel for many. Whereas some OPEC members, they need prices, way higher. Over $80 sometimes, just to balance their national budgets.
So that difference creates this sort of tension, a potential cap on prices.
You could see it that way, yeah. It puts a ceiling on how high prices might sustainably go before more U.S. shale potentially comes online.
Okay, that makes sense. So supply and demand, lots of moving parts. But then there's geopolitics. That always seems to throw a wrench in the works.
Always. And right now, yeah, plenty of hot spots influencing things.
Like Venezuela. I saw something about a military alert.
Mm-hmm. And the U.S. revoked some gas licenses offshore there. That's expected to cut their output by maybe 200,000 barrels a day.
Okay. Not insignificant.
No. And then you have Russian Urals crude. With the EU embargoes and shipping restrictions.
They had to find new buyers, right?
Exactly. So that oil is getting rerouted mostly to places like India and China, often at those discounts we mentioned.
And the U.S.-China trade friction. That's still hanging over everything.
Oh, absolutely. The threat of more tariffs, a wider trade war. It's a major concern for global growth.
And slower growth means less oil demand.
That's the fear. Energy News highlighted that analysts are worried about China's economy specifically because of this potential trade decoupling.
Right. And U.S. sanctions on Iran are still in play, too.
Still a factor, yeah. And those sanctions often interact with what OPEC Plus decides to do on production. It's all interconnected.
It really is. And didn't Venezuela's state oil company, PDVSA, just do something with Chevron?
They did. It revoked Chevron's authorization to export crude. That led to a massive 78% drop in their exports expected by May.
Wow, 78%. That's sudden.
Very sudden. Shows how quickly politics can hit the physical supply. And in Europe, things are still tense with Russia.
Still trying to reduce reliance on Russian energy.
Yeah, the EU is looking at potentially tighter restrictions on Russian crude imports, and they're also trying to figure out how to get out of long-term Russian gas deals without penalties. Both Atlantis Press and Discovery Alert mention this ongoing effort.
It feels like we see this pattern again and again. Political instability flares up, oil prices jump.
History backs that up. Atlantis Press mentioned the Russia-Ukraine war starting in February 22. Prices shot over $100 a barrel almost immediately.
Right. These aren't just blips. They can reshape the whole energy map.
Exactly. Which actually brings us to something a bit fuzzier, but still really important. Market sentiment.
Ah, the psychology of the market, not just the numbers.
Precisely. It's the collective feeling, the vibe. Are traders feeling bullish or bearish? Where they think prices are headed?
And that DCU research you mentioned actually tried to measure this.
Yeah, from Doris at Dublin City University. Really interesting stuff. They built these sentiment indices for WTI and Brent looking back from 2002 to 2013.
How do they even do that?
Well, they use proxies, things that might reflect mood, like trading volumes, how much prices had swung around historically.
Volatility.
Right, historical volatility. Also, the put-call ratio, that's options market stuff, speculation indicators, even implied volatility from the stock market.
Okay, so they crunched all that data. What did they find?
Basically, they found that including these sentiment measures significantly improved their models for predicting oil prices during that time.
So feeling actually matters. It's not just fundamentals.
It suggests it has a real measurable effect. And maybe not just in extreme crises, but more consistently.
Huh. So even if supply looks tight, if everyone's feeling gloomy, prices might not go up, or vice versa.
Exactly. Sentiment can potentially override or amplify the fundamental signals, and we might be seeing that right now.
How so?
Well, that April 16th Discovery Alert noted prices were surprisingly depressed. This was despite a big drop in U.S. crude inventory.
Which normally would push prices up, right? Less supply available.
Typically, yes. So the fact prices stayed low could mean broader worries about the economy, maybe, or just negative sentiment is sort of outweighing that bullish inventory news.
Like the market's just not buying it.
Kind of, like it's saying, yeah, inventories are down, but I'm still worried about other things.
And I think I saw something about bets on future prices. Net long positions being low.
Yeah, the April 17th alert mentioned historically low net long positions in WTI futures. Lots of people not betting on prices going up.
So could that low number of bulls actually be a sign that things might turn? A contrarian indicator?
It could be, potentially. Sometimes when sentiment gets extremely one-sided, like very bearish, it doesn't take much positive news to cause a sharp rebound. Like, everyone's leaning too far one way.
Okay, interesting. So we got supply demand, geopolitics, sentiment. What else is lurking in the background, influencing prices day to day?
Oh, there's always more. Seasonal demand patterns, for one.
Summer driving season, winter heating.
Yeah, though those patterns are getting a bit disrupted by everything else lately. Then there's the spread between Brent and WTI.
The price difference between them. It's been widening.
It has. Discovery Alert linked it to logistics, transport costs, even small quality differences between the crudes.
And shipping costs in general affect regional prices too, I imagine.
Definitely. Plus, you have specific infrastructure things like the Keystone Pipeline restarting.
That should help Canadian crude prices. narrow the discount.
That's the expectation, yeah. Reduce the bottleneck there.
Okay. And long term, we can't forget the energy transition, can we?
Absolutely not. The whole shift towards renewables, while oil is dominant now, increasing investment in clean energy, like we're seeing heavily in the UK with grid upgrades, that impacts long-term demand forecasts for oil.
And countries are shifting who they buy from, too, right? Indonesia, Pakistan looking at U.S. LNG,
Yeah.
the EU doing the same.
Exactly. It's reshaping those global energy relationships. A big realignment underway.
But fossil fuel production isn't stopping. Brazil's still auctioning oil blocks. BP found more oil in the Gulf.
Despite environmental pressures, exploration and production continue. And technology plays a part too, even in the short term. Algorithmic trading.
The bots.
Yeah, the trading models can react super fast to headlines or technical levels, sometimes making price swings bigger than they might otherwise be.
And those Canadian pipeline issues you mentioned, they keep Canadian oil cheaper.
Yeah, those capacity constraints mean persistent discounts for Canadian benchmarks. It's an ongoing structural factor. It's really complex, so many layers.
It truly is. Now, stepping back a bit, that Investopedia article gives some good historical context, doesn't it? Reminds us this volatility isn't new.
Not at all. They walk through the big ones: the Arab oil embargo in the 70s, the Iranian Revolution, Gulf War, the 2008 price shock.
Right. Huge geopolitical events, economic shifts.
Yeah.
They've always caused massive swings in oil prices. It puts today in perspective.
It really does. And they specifically mentioned 2020.
Oh, yeah. The Russia-Saudi price war, plus the pandemic hitting demand.
Prices collapsed. WTI even went negative for a bit there. Unbelievable.
Crazy. So today's ups and downs, while significant, are part of this much longer pattern.
Exactly. And speaking of recent history, the Russia-Ukraine war's impact. That Atlantis Press article really detailed the energy consequences.
Yeah, what were the key takeaways there?
Well, the immediate price surge after the invasion in Feb 22, obviously. Brent and New York crude jumping over $100. Then the Western sanctions on Russia talk of EU import bans, kicking them out of SWIFT.
And Russia shifting its sales eastward.
Right, towards Asia, India, China. The article also notes the debate about how effective those sanctions have actually been economically. And importantly, just the sheer uncertainty the war creates. That can make companies delay production plans, consumers delay purchases. And that uncertainty itself impacts prices.
So wrapping this all up, as we bring this deep dive toward a close, it's just crystal clear, isn't it? The price of oil isn't simple.
Not even close. It's this incredibly complex mix. Supply-demand, yes, but also geopolitics, market feelings, logistics, technology, history.
Everything interacting.
Everything interacting, and you really need to consider all those pieces to even begin to understand why the market moves the way it does.
And why it can sometimes seem counterintuitive, right? Like prices staying low even when inventories drop.
Exactly. It shows you need that wider perspective. You can't just look at one factor in isolation.
Okay, so here's a final thought to leave everyone with. Something to chew on.
Right.
Given everything we've talked about, the historical volatility, how interconnected global events are now, politics, technology,
Yeah.
how might some totally unexpected development, maybe a geopolitical shock, maybe a sudden leap in battery tech or fusion energy, how could that completely reshape the oil market in the years ahead.
Yeah. A black swan event.
Exactly. And what do you think might be the single most surprising consequence if something like that happened?
Definitely something to ponder.
It is indeed. Lots to think about.
Thanks for taking this deep dive with us.